Imagine this. Over the next decade, Indian stocks double in value. 100% returns on your equity portfolio. Sounds like a dream, right? But here's a quick reality check. In the past 10 years, the rupee has slipped down around 65 to over 87 against the US dollar. A depreciation of nearly 30%. Why? India's persistent current control deficits, higher domestic inflation versus the US, and shifting global capital flows have all conspired to weaken our currency. And these forces aren't going away anytime soon. Now flip the script. Picture your portfolio going from 10 lakhs to 20 lakhs over 10 years. Yet if the rupee moves from 83 to 125 per dollar, which is a 40% drop, that 20 lakhs suddenly buys only half as much overseas. Your double becomes a wash once you account for a currency loss. Few advisors will flag this danger. They focus on rupee-dominated returns because their fees depend on domestic products. Advising you to hedge currency risk with offshore assets would eat into their revenue, so the warning rarely comes. But when it's time to cover foreign tuition fees, medical bills abroad, or simply preserve purchasing power in retirement, a weakened rupee bites the hardest. All your careful stock picking and market timing can be undone by invisible currency drift. So here's the unspoken truth. Protecting your long-term wealth means planning for a rupee that may lose half of its value. Celebrating big headline returns isn't enough. What matters is what you can actually spend. And in the next section, we'll cover and explore what exactly is currency risk and how it affects your retirement. Chapter 1. The hidden threat, currency risk in your retirement. When you talk about planning for retirement, most conversations revolve around asset allocation, equity returns, and building a sizable corpus in rupee terms. But there's an invisible tax that erodes your future purchasing power every single day: the currency depreciation. In this chapter, I'm going to unpack the currency risk and how it is a stealth assassin of all long-term wealth, how it shows up in your retirement calculations, and why ignoring it can turn your dream nest egg into a painful shortfall. So number 1, what is currency risk and why you should care? Currency risk basically refers to the possibility that fluctuations in exchange rate will reduce the value of your domestic currency investments when measured in a stronger foreign currency. If you plan to spend your savings on goods or services priced in dollars or euros or any other foreign unit, a weakening rupee magnifies your cost. Inflation versus FX. Even a moderate 4 to 5% annual inflation in India pales next to a 6 to 8% annualized depreciation of the rupee versus the dollar over the past decade. And here's the cumulative impact. A steady 5% currency decline compounded over 10 years equates to a roughly 63% loss in purchasing power, almost 2/3 of your wealth gone even before you step foot in a foreign economy. Number 2, everyday examples feeling the pinch of a weakening rupee. Number 1, education abroad. Consider a family budgeting for a 4-year US bachelor's degree. In 2015, the tuition plus living expenses at a mid-tier state university might have cost around $25,000 every year, which is 1.5 million rupees or 60 rupees a dollar. Today, the same $25,000 bill translates to roughly 2.1 million rupees at $84. That's now a 6 lakh annual shortfall purely from the currency swing. Number 2, healthcare and medical tourism. India has become a hub for cost-effective medical procedures, but high-end specialties still require overseas treatment. A procedure priced at $30,000 in Singapore jumped from 1.8 million rupees at $60 a share to 2.52 million at $84 a share today. Seniors budgeting for complex care in retirement will discover their well-laid plans strained by rupee weakness. Number 3, overseas travel and lifestyle. Retiring globally often means extended stays in Europe or North America or Asian beach towns. In 2010, 1,000 euros monthly rental in Spain cost at 65,000 rupees. Today, it's closer to 90,000. That's a 38% hike. That has nothing to do with local inflation. It's a purely currency effect. Number 4, why advisors stay silent on currency risk. It's basically a product-driven fees. Domestic mutual funds, pension products, and insurance plans generate a bulk of advisory revenue. Suggesting offshore ETFs or direct ADRs or foreign currency holdings can cannibalize those fees. Compliance over confidence. Many advisors lack proper licensing or comfort to hold these foreign assets, so they default to rupee-dominated solutions even when they aren't optimal for clients. Perceived complexity. Currency hedging, tax treaties, and foreign asset custody can seem daunting. It's easier and more lucrative to sell what's familiar than to educate on global diversification. Beyond the numbers, behavioral blind spots. Now, here is the point of home currency bias. Investors often overallocate to local markets and currencies because they know them best. The emotional comfort can blind you to the real risk. Illusion of safety. Rupee returns look stellar on paper, double-digit for decades, But this illusion shatters when you translate rupee gains into actual spending power. Timing traps. Attempting to time the currency cycle is a fool's errand. Rupee slides can accelerate during crisis, meaning waiting for a better entry could cost you dearly. And here's the wake-up call. If you're within 10 to 15 years of retirement or helping children budget for overseas studies, currency risk isn't theoretical. It's a material drag on your goals. Every percentage point of your annual rupee depreciation chips away at your corpus and amplifies the cost of foreign priced in necessities. Now coming to chapter 2, why plan B is global diversification. When domestic returns look attractive, it is tempting to park your entire retirement corpus in Indian equities and debt. But as we have seen, rupee depreciation can erase much of your headline gain when you convert back into dollars or euros. Enter plan B, which is global diversification. By allocating a meaningful slice of your portfolio to overseas assets, you can cushion currency swings, tap into different economic cycles, and own world-leading companies unavailable at home. In this chapter, we'll basically examine the historical case studies that highlight the payoff on going global, and then dig into the core benefits that make diversification an essential hedge. Number 1. Historical case studies. India only versus 80 to 20 India global, 2010 to 2020. Now, let's first give a chance to the India only portfolio. Your composition is 100% invested in a broad Indian equity index, for example, Nifty 50. Local return, approximately 12% annualized over the decade. Rupee move, INR basically depreciated from $45 in 2010 to maybe $75 in 2020, which is basically a 40% loss. USD adjusted return, your 10 lakhs has now become 31 lakhs at 12% per annum. Their effective USD CAGR is roughly 7.1% versus the 12% nominal. And in the 80 to 20 case, where let's say 80% in India is 20% is global, your composition is 80% Nifty and 20% S&P 500 USD dominated. Now the local blend, which is roughly 11% in rupee terms, and the USD adjusted outcome, there is a better currency cushion because the 20% S&P slice effectively hedged a portion of that rupee slide, boosting effective USD CAGR to 8.5%. Now, in terms of the total gain, you'll see a noticeable uplift in the dollar terms wealth, translating to tens of thousands of dollars over 10 years. And coming to point B, Argentina's 2010 lesson, proxy for currency stress. While India's depreciation has been moderate, other emerging markets have fared far worse. Argentina's peso lost over 80% versus the dollar from 2010 to 2020 under chronic inflation and capital flight. An Argentine investor fully invested in local assets would have seen spectacular nominal gains in pesos, yet would have been left with a fraction of their original dollar purchasing power. By contrast, those who shifted even 10 to 15% of their savings into global blue chips or US Treasury bills preserved significant real wealth. Now, takeaway here is if an 80% FX loss can happen in a soft crisis, a 50% drop in India over 10 years is well within historical precedent. Now, here are the core benefits of global diversification. The first one is the natural currency hedge. Allocating even a modest 20 to 30% to a foreign assets directly offsets rupee weakness. When the rupee slides, your US dollar dominated holdings appreciate in rupee terms, even if the underlying stock prices remain flat. This built-in cushion can smooth your portfolio volatility during periods of sudden FX stress. Point number B, sector and economic diversification. Beyond banking and IT, India's market is heavily skewed towards financials, oils and gas, and IT services. But in contrast, global markets offer deeper exposure to sectors like healthcare, consumer staples, industrials, and emerging technologies. And then there are different cycles. India's growth trajectory is tied into domestic GDP, interest rate cycles, and regulatory shifts. Global economies move at their own pace. US tech booms, European infrastructure cycles, and Asian consumer upticks aren't perfectly correlated with India. By blending these, you can reduce the risk of being hit by a sharp downturn in any single economy. Access to world-class franchisees. Some of the most profitable and innovative companies have come out of US, for example, Amazon, Apple, Microsoft, Nvidia, and many others. Either don't list in India. A direct global allocation lets you ride the growth in the cloud computing, biotech, e-commerce, pharma, luxury brands that have no comparable in your domestic peers. Over the long run, owning these global companies can tilt your portfolio toward a high return opportunities. Another point here is geopolitical risk mitigation. Even well-run countries face policy risk, tax changes, trade wars, election-driven volatility, and when you concentrate 100% in just one market, you amplify those political and regulatory risks. A global approach spreads exposure across multiple jurisdictions, A crackdown in one currency may be offset by a boom in another. And another point here is behavioral discipline. Investors often fall prey to home bias and herd behavior, chasing fads in local stocks at market peaks. A global framework with clear target allocations enforces discipline. A systematic rebalancing, selling a bit of the outperformer, buying the laggard, introduces contrarian rigor that can enhance returns and reduce emotional mistakes. Three, where we are putting it all together with an example of the portfolio impact of this strategy. We're taking three different portfolio situations here, which is 100% India only. You capture the full punch of India's high nominal returns. So if the rupee only weakens modestly, let's say 15 to 20%, you end up with the largest rupee dominated corpus, but you are 100% exposed. Any super slide in the rupee will directly erode your purchasing power. The next is the 80-20, where 80% is India and 20% is global. By putting just 1/5 of your money to offshore, you give yourself a cushion. About 20% of your portfolio now moves in sync with the dollar. So you offset a fifth of whatever rupee loss you see. In a mild depreciation scenario, your final rupee corpus is only about 5 to 10% smaller than the India-only case. But you've already hedged 20% of any deeper currency fall. Now let's take another example, which is 60-40. 60 India and global 40. A heavier global tilt, which is 40%, now smooths out roughly 2/5 of your rupee drag. You trade off another 5 to 10 points of nominal rupee growth for a steadier, more predictable real outcome. So ending rupee corpus may be 10 to 20% below the pure India path in gentle FX scenarios, but you absorb almost half of any sharp rupee declines. The bottom line here is that each 20% that you shift to offshore trims your headline rupee gain by a few points. But in return, you buffer exactly that slice of currency risk. You sacrifice a small chunk of your upside when the rupee holds up, so you're protected when it doesn't. Choose your blend based on how much rupee slide you are ready to weather versus how much hedge you would want in place. Now, here are some common objections that I would like to address. First, obviously, it's too complicated. Now, modern platforms like Appreciate offer one-click access to US ETFs and stocks. Feeder funds and simplified LRS investments make the process almost as easy as buying an Indian mutual fund. Emerging markets look cheaper. Now, if you believe in India's growth story, and you should, adding global assets isn't a vote of no confidence. It's a prudent risk management thing to endure that rupee risk doesn't overshadow India's upside. And now, global diversification isn't about abandoning India, it's about enhancing your overall portfolio resilience. By blending domestic strength with offshore stability, you lock in real purchasing power, access sectors beyond local horizons, and build a retirement corpus that stands firm even if the rupee slides further. In the next chapter, we'll translate these insights into actionable blueprint, specific allocations, investment vehicles, and rebalancing rules to make a plan B, which is concrete as a part of your financial roadmap. Chapter 3. Building your global plan B action steps. Now that you understand the why, let's map out the how. This chapter gives you a concrete blueprint for blending offshore assets into your portfolio, step-by-step guidance on investment channels and tax implications, and the checkpoints you need to keep while you keep your plan B humming along. Number 1. A portfolio blueprint, designing your offshore slice. A one-size-fits-all doesn't exist, but here is a starting framework you can tailor by age, risk tolerance, and goals. So here's the risk profile. You have domestic, which is INR, offshore, which is USD or some other. Now you'll see a table on the screen here. So first I'm taking a conservative example, which is 10% offshore. So 5% is in US Treasury bonds, ETFs, and 5% is in global aggregate bond funds. Now there is a balanced example, which is 30% offshore, 15% in S&P 500 or MSCI ACWI ETFs, 10% in global bond ETF, and 5% in developed market property REIT funds. Here's an aggressive example, which is 50% offshore, 30% in US and EAFE equity ETFs, 10% in emerging marketing equity, and 10% in thematic global tech funds. Now, you have to aim to revisit and adjust once a year if you're too busy, or quarterly if you have more bandwidth. Now, let's come to the second part of this, which is the practical know-how to making it real. The channels of entry are very important here. How will you start to invest in these global funds? Now, through Indian mutual funds that pool rupee subscriptions and invest in established offshore ETFs, there is an example called Motilal Oswal Nasdaq 100 Fund. Pros, it's rupee dominated, Indian KYC, tax process is all fine, it gives you that SIP discipline, but the cons are that it has a higher total expense ratio of 0.5 to 1.2%. The next is the liberalized remittance scheme via direct equity/ETFs. Now you can remit up to $250,000 in USD per financial year. You can buy US ETFs like SPY, VT, ADRs like Apple, Nestle, or brokerage listed overseas stocks. Pros are that there are lower expense ratios, direct control, and broad universe. But cons are that the currency conversion costs, additional reporting in brokerage interface, learning curve would be there. Next would be the offshore bonds and fixed income. You can have access to US Treasury ETFs, for example, TLT, global aggregate bond funds via LRS. Why? Because this provides stable coupon income and diversification away from rupee denominated bonds. And here are some digitally accessible platforms. So they basically give you features like one-click ETF purchases, fractional shares, in-app tax reports, and on platforms like Appreciate, you even get detailed research reports along with the AI recommendation engine. Now let's talk about the tax and compliance considerations. Under the LRS reporting, you have to declare all overseas investments from 15 CA 15 CB where applicable and include details in Schedule FA of your ITR. Now let's talk about the capital gains treatment. Equities, which are let's say ETFs or ADRs, short term if held less than 24 months, are taxed at slab rates. Long term, which is greater than 24 months, 20% post indexation. Debt fund / fixed income, short term greater than or equal to 24 months, long term greater than 24 months, which is 20% post indexation. Now let's come to the dividend and withholding taxes. Many ETFs / ADRs pay dividends subject to foreign withholding. You can typically claim credit against the Indian tax due. Now, currency loss deductions. Any FX loss on a sale can be offset against capital gains or document conversion rates accurately. So that's it, guys. That was all why you should be looking forward to global investing, because while rupee depreciates, you can diversify globally